Hello and welcome to Trading 5 Talents. In today's video, I want to go over an options trading strategy that can profit when there's a big price move in your underlying stock. And that price move can be up or it could be down. So as long as there's a big move, this strategy will make you profit. And it's called a straddle. So a straddle is when you buy a call and a put with the same expiration date and at the same strike price. So a call and a put simultaneously. And you're going to enter this trade for a debit. So it's going to cost you something to enter this trade. The example that we're going to look at is going to be using ticker symbol AMC. So remember our price line going from left to right, low to high in terms of price. Our current stock price is indicated by the vertical dotted line. And we're going to use AMC. So I've already set it up, and I'll explain what each of these options are. So on the call side, we are purchasing the 13 call for the 5/27 expiration. And you can see that here in the green arrows. So on the options trade diagram, a green icon represents a call. And then we are also going to be buying a put at the same strike price. So the 13 strike put, both of these are on the long side because we're buying both of them. So the call will cost us $1.55 per contract. The put will cost us $1.96 per contract. So because we're purchasing both of these, we simply add the debits together, and $3.51 is our debit that we owe. So multiplied by 100, it's going to be $351 that we need to enter this trade. So the trade is set up pretty easily. It's just two options, buying a call and buying a put. The way that this trade makes money is the further the stock moves away from the strike prices, the more money can be made. And I'm not sure if you caught it on the last screenshot, but the upside is unlimited. So it doesn't matter the direction of the move so long as it moves away from the strike prices. So the max profit is unlimited with this trade setup, and the max loss is going to be how much you paid to enter the trade. In our example was $3.51. So $351 is the max loss that you could have sustained in this trade. So let's go over to optionstrat.com and we'll take a look at the profit and loss graph. All right, so here we are on OptionStrat, and if you just go over to build and hover over, we are going to be looking for a straddle, and it's right here under the intermediate strategies under directional. Click on straddle. All right, we want to use AMC as our example. We'll click on that. All right, so we did 5/27 as our expiration, and then we had the 13 strike prices as our call and our put. So let's zoom out in the chart range so that we can see the full profit and loss profile. And that would be right here. Well, let's zoom out even more. So that would be right here. Now, at the time of making this video, you can see that the net debit, or how much it cost us to enter this trade, was $328. That's the maximum loss that we can also sustain on this trade, whereas the max profit is infinite. And in order for this trade to make profit, it's got to move away from the strike prices. So right now, the current share price is here in the vertical dotted line. And if it stays right there, we're going to be losing money as this approaches expiration. So we need it to go down. You can see here 972 in this vertical blue line. These are our break even. So it needs to drop lower than 972, or it needs to go above 1628 at the time of expiration. Now, of course, these break evens are going to be different over time, but as of expiration, it needs to move that far in order for it to be profitable. So here I've moved it to the day that we open this trade. You can see the break evens are much more narrow. So if you open this trade, you can see the break evens are 1131 on the downside and 1352 on the upside. If the stock happened to move past one of those two prices the day you open this trade, you could close it for a profit. If there was a big crash, then you could see that you would have made a lot of money. Or if for whatever reason the stock just went up, you can make a lot of money as well. So the closer and closer you get to expiration, the farther and farther the stock has to move away from your strike prices in order to make money. So as of right now, it doesn't need to move very far from the current price in order for you to make money. But as you get to expiration, it's got to move quite a bit in order for you to make make your profit. And the reason is because you're going long on both the call and the put. Therefore, they're going to be subject to theta decay. So once again, like the other trades that we have looked at, you can move these strike prices to make it more bearish or more bullish. Usually these straddles are played right at the money. So if, for example, AMC is at $11.81, you would probably place the strike prices at $12 or $11.50. You would put it right at the money because that would give you the highest chance of profit. Now let's look at the advantages and disadvantages of the straddle trade. So the advantages, it profits from very large moves in the stock. And as you saw from the option strat graph, the closer you get to expiration, the larger those moves have to be. So as soon as you open the trade, the move doesn't have to be as large. It can move down or it can move up, and you'll still be able to profit on this trade. And therefore, it can be a bullish or a bearish setup. You don't have to be correct in accurately determining or predicting which direction it's going to move. Now, the disadvantages. One, it's expensive. It's an expensive trade setup because you're buying two different options. Okay, there's no selling going on here. You're buying put and you're buying a call. So whatever those costs, add them together, that's how much it's going to be. So you're not receiving a credit at all. You're paying a debit. Secondly, longer order fill times because two options need to be purchased instead of just a single option order. And because you have two options to fill, there's going to be more commissions because you have to not only open these options, you would have to close them as well. So you're going to be paying commissions on both sides. I didn't mention it previously, but you don't have to wait until expiration to close out any of these trades that I've been highlighting. You can always exit early for a profit. So you just do the exact opposite of how you entered. If you bought an option or you bought a straddle, then you would simply sell that straddle in order to close it. Usually I close my trades anywhere from 50 to 90% of the maximum profit that I could get from that trade. Now with a straddle, because the profit's unlimited, you would want to have maybe a price target or a profit target. For example, if you paid, I don't know, $300 to enter a straddle, you may want to exit when you make $100 or you make $150 or whatever that profit target is. You should have that in mind, so that you don't just keep it open and have theta decay reduce your profits. And the fourth disadvantage that I see with the straddle trades is the time decay when you go long on options. If there are small moves in the stock, that could be advantageous if there's a lot of time left in the trade. But small moves, they don't really make this trade setup very profitable. You need large moves away from your strike prices. Time really has a negative impact on these long straddles. Now you can do a reverse straddle or a short straddle or an inverse straddle, whatever you want to call it, but it's basically the opposite. So instead of buying a put and a call, you would sell a put and a call at the same strike price. And so the profit and loss profile would just be the exact opposite. So instead of the stock having to move in a big direction, you would want it to stay in a very narrow range in order for you to make all of your profit. And the profit that you're going to make is going to be the credit that you're going to receive from selling this straddle. So those are the advantages and disadvantages I see with straddle trades. It's a very easy trade setup because you're just buying two options. And of course, they can be very profitable if you have that large move in the stock. So that's it for straddle trades. If you have any questions about this or any of the other trades I've gone over recently, go ahead and leave a comment down below, or you can catch me on Twitter at Trading5Talents. In the meantime, if you'd like more videos about option strategies or about the wheel strategy and selling options to pay off monthly bills, then go ahead and click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.